Have you heard it's not about how much you make, but how much you keep? And not all income is treated the same. And we're going to talk about that right now. Welcome to Wealthy Stewards Academy. Here we help you increase your financial IQ and buy back your freedom. So there's three types of income, and they're all not treated equally. And what I mean by equally, I'm talking about tax purposes. And it's important to know which one the majority of your income is coming from. So the three types of income are earned income, which is also called active income. There's passive income, and then there's a subset of portfolio income, which is technically a type of passive income. So let's talk about active income. As of July of 2022, this year, there has been 138.8 million people that have full-time jobs. And so these are 9-to-5 jobs, or it could be part-time jobs. But this is what you get when you get a W-2 or you do some type of contract work where you're working for an employer. And that's where the vast majority of people make the majority of their income. So the next type is passive income. Now, passive income should be called deferred income because you actually do the work once and then you get paid for it continuously later. And so things that fall into this category is like you buy some real estate, you rent it out to someone, and then they pay you rent. So rental income. You write a book or you do some type of digital art like an NFT or something, and you get paid royalties based on every time that someone buys your stuff. The third type is portfolio income. And with portfolio income, the way it works is that you buy an asset and then you sell it later at a higher price, and then you get taxed on the amount that you gained. So then there's dividend income. And with dividend income, you purchase a stock or a fund, and with this specific type, you will get paid out of the company's cash either monthly, quarterly, it's usually quarterly, or yearly. All right, so as I mentioned before, it's not so much about how much you make, but how much of it are you actually keeping. So you have active, passive, and portfolio. And as I mentioned earlier, they're not all treated the same. You see, with your active income, you have to pay FICA taxes, which is Social Security and Medicaid taxes. And then you have ordinary income tax, which is your basic standard tax rates. So depending on how much you make, whether it will either be 10% as of this year going to next year, or I'll go all the way up to 37%. And so those are the tax rates that you'll be paying based off of your earnings that you make this year. So then you have passive income. And with passive income, you actually do not pay any FICA taxes, whether it's portfolio or just straight up passive income. And you also don't pay ordinary or earned, because the money is not earned, it's unearned income. So it's a different tax category. Now, if you hold this asset for longer than a year, then your tax that you will pay will actually pay lower. And the reason for this is because short-term capital gains, which means you hold the asset for less than a year, is actually treated as an ordinary income. But if you hold it for longer than a year and you don't sell it, you actually fall into the category of a long-term capital gains. And what this means is that you actually will pay lower amount in taxes. And so you're either going to pay 0, 15 to 20%. Of course, this all depends on your filing status and the amount of taxable income that you have. But generally speaking, your long-term capital gains taxes are always, generally speaking, lower than your ordinary taxable income. So you have 100% of your income. If you slice it up over the majority of that pie, there's more active income inside of there than there's passive income. So if you make more passive income than active income, then that means that you'll actually keep more of your money. And there's lots of ways to create passive income, and there's lots of ways to create active income. But instead of having higher active income than passive income, you reverse it. And when you reverse it, you'll keep more of your money. So if you found this video helpful, don't forget to hit that like button, and I will see you in the next video. Swift out.